Stakeholders are always concerned about the quality of the information that they receive. In order to ensure that the information they receive is of high quality, we have qualitative characteristics and assumptions. Now, I'm not going to run through all the definitions of the qualitative characteristics and the assumptions. That's what the textbook is for. So if you haven't brushed up on that, you're going to have to go back to the textbook and read about that. Instead, what this question is doing is getting you to connect the qualitative characteristics and the assumptions, because that will give you a deeper understanding of both. How so? This question forces you to think about the definitions of each of these. You can only complete this exercise if you have that understanding. So this is demonstration question 1-3. Draw a line between the qualitative characteristic and the assumption you think was developed to ensure that financial information has that quality. Note that some characteristics may connect to more than one assumption. So the qualitative characteristics are the qualities that stakeholders want financial information to have, and the assumptions are used by the preparers to prepare the financial statements. So faithful says that it's free of error, neutral, and complete. If information is going to be free of error, then we have to apply the separate entity assumption. The separate entity assumption says that the information of a business will not be mixed up with the information or the records of the owners. If we separate owners from the business and we only record the business activities, then we know that it's free of error and it's complete. So faithful connects to separate entity. Unit of measure says that we will use the same currency on our financial statements, and we assume that the currency is stable over time, so we ignore inflation. But I don't think that connects to faithful. When we think about faithful, neutral, unbiased, free of error, I don't know. Unit of measure to me does not connect. Going concern says that the company will go on into the foreseeable future, and I don't see how that connects to faithful. Time period, also called periodicity, says that we can break the life of a company up into arbitrary time periods, but I don't see how that connects to faithful. And historical cost says that when we purchase an asset, we use the value that we paid for it, and that doesn't tie into faithful either. Full disclosure says that we're going to make sure the information provided to the stakeholders is complete so that they can understand the financial statements. Well, that definitely ties into faithful. Faithful says complete, and full disclosure says complete information. So I think there's a connection there. Let's move on to relevant. Relevant information is information that allows us to make decisions. Relevant information has predictive value, meaning we can use it to predict the future or attempt to predict the future. And it has confirmatory or feedback value, which means that once we have the real information, we can compare it to our predictions and it'll give us feedback. So when you think about it, relevant information for a business would be only the business's activity. So it's connected to separate entity because it should only be the business's activity that are on the financial statements. When I look at unit of measure, I don't think it connects to relevant. I mean, it might, but I don't think so. Going concern. Well, if a company is a going concern, then we can use the information from today to predict the future. If the company is not a going concern, then we're not going to be able to use any of the information for predictions. So I think relevance is connected to going concern. Time period, periodicity, we can break up the life of a company into arbitrary time periods. Well, actually, I think that is relevance, because if we don't break up the life of a company into arbitrary time periods, then we wouldn't get financial statements at all because there would be no break in the company. So if a company is 150 years old, we would have 150 years of data. So that's not relevant to decision making. We can't use that to predict. In fact, if we break up the life of a company into like an arbitrary time period of a year, we can use that year to predict the next year. So I think relevance is connected to periodicity, also called time period. Historical cost, relevant information. Actually, historical cost might not be relevant. And then we've got full disclosure. I don't think relevance and full disclosure tie together. Like having predictive value, full disclosure, it doesn't make sense to me. I'm finished with relevance. Let's move on to comparable. Comparable and separate entity, I don't think the two of them go together. Comparable and unit of measure. If we ignore inflation and we use the same currency, then information will be comparable because we can compare a prior year to the current year because we're using the same currency and we're not changing anything. So I think comparable is connected to unit of measure. Now, comparable and going concern, I don't know if that's connected at all. Comparable and time period. Because we're splitting up the life of a company into arbitrary time periods, we can then compare one year to the next year. So I think comparable is connected to time period. And then comparable and historical cost, it doesn't work for me. Comparable and full disclosure, that's not working for me either. Let's move on to the next one. Verifiable. Verifiable means that we have the ability to go to a document, a source document, and actually see the value of this item. So to me, verifiable immediately jumps to historical cost. This is because historical cost is verifiable, right? We can go look at the document and we'll know. Going through the remainder, separate entity, I don't think it works. Unit of measure, that doesn't make sense either. Going concern, nope. Time period, nope. And then full disclosure, no. So to me, verifiable only goes with historical cost. Now let's look at timely. Timely means that information is given to the stakeholders quickly enough to still have the ability to change their mind. So for instance, if I get some new information within 2 or 3 days, that's far more valuable than getting that information in 2 years' time. Let's look at what it's connected to. Timely and separate entity. I don't think timely is connecting with separate entity. Units of measure, no. Going concern, no. Time period. Well, if we break up the life of a company into arbitrary time periods so that we can report information, then that information will be given to the stakeholders in a timely manner. So I think timely and time period totally connect. And then historical cost doesn't affect timely, and full disclosure does not affect timely at all either. The last one is understandable. Understandable means that someone who is using the financial information must have an appropriate level of knowledge of both accounting and the economy. If they don't, they will hire somebody who will actually help them to understand it. When you're looking at understandable, well, information that is understandable would have separate entity, right? Because when you think about it, if the business was not separate from its owners, then you wouldn't understand it. So understandable definitely ties into separate entity. Unit of measure. Well, the financial statements are only understandable if the unit of measure used is the same every single year, every single time. Same currency. Going concern. We have to understand either that the company is going to go forward into the foreseeable future or that they're going to fold, liquidate. So if we don't understand this, well, we're going to have problems understanding the information. Time period. If the company is not broken up into arbitrary time periods, such as a year, you're not going to understand any of the information anyway. So we have to have time period. Historical cost. I don't think that's tied into understandable at all, because historical cost is just historical cost. And then full disclosure. Well, if you don't have full disclosure, then you don't have understandability, because the stakeholders have to be able to look up what rules you've actually used. So understandable ties into the majority of the assumptions. Keep in mind, it's important to understand all the qualitative characteristics and their definition and how they flow into the assumptions. Also remember that the qualitative characteristics are the qualities that stakeholders want information to have. And the assumptions are used by the preparers of financial information to ensure that the information they provide to the stakeholders has those qualitative characteristics. Thank you very much for watching.